boxed in. They can't turn it around the way Volcker did in the 80s. The economy would be devastated if they raised interest rates to 5%, never mind 20. So there doesn't seem to be a way out other than hyperinflation.
Please join us for our next live stream
Sunday, September 18th
at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be
Sunday, September 18th
p.m. Eastern. See you then.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Nick Barisheff joins us today. Nick is the president, CEO, director, and founding partner of BMG Group Inc. BMG manages 3 Canadian mutual funds, a physical bullion program for high net worth investors, and the BMG Diversified Hedge Fund. Nick is also the author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. And Nick has been actively involved in the finance and investment business for over 45 years. Wealth of experience. We're delighted to have Nick join us here for the first time today. It's time to saddle up and silver up for Nick Barisheff. Nick, welcome to SBTV. How are you doing?
Very good. Thank you.
Glad to have you on. It's our first time, so it's a real treat for me to talk to you. Your book, titled $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. Can you tell us what got you to write that book and why the inevitable rise?
Well, the main conclusion was that up until 2011, the price of gold was almost perfectly correlated to US dollar debt. So as the debt increased, the gold price increased and so on. And if you were just to continue with the normal progression of debt, you got to 10,000. Now, of course, it's all changed because the money printing and the debt has gone absolutely ballistic in the last 2 years, and particularly under Biden. So now the $10,000 estimate, there was an article with about a dozen different economists and all the predictions, and my $10,000 prediction was at the bottom. The top one was 87.5. So this is how much things have changed and where things are going. The policies, when you look at what they're doing in terms of going into debt and printing money, it's almost a certainty that we're going to have hyperinflation. And if you have hyperinflation, then the numbers become absolutely absurd. When you take a look at the German hyperinflation in the 20s, like gold started off at 75 marks an ounce, and then 2 or 3 years later was like over $1 trillion. That's what happens during a hyperinflation. And the thing is that they're boxed in. They can't turn it around the way Volcker did in the 80s, where he raised interest rates to 20%. The economy would be devastated if they raised interest rates to 5%, never mind 20. So there doesn't seem to be a way out other than hyperinflation. And then when you couple that with the fact that the US dollar, its reign as a reserve currency is the longest of all the reserve currencies in history, and it's due for a replacement, which is what seems to be in the works now with the essentially an Asian Bretton Woods between China and Russia to create a new currency to be used by all the BRIC members and so on, which is like 3/4 of the world's population. And that the intent of that currency is to be backed by gold or commodities, but backed by something. So this is well underway. And Putin has started an alternative to the LBMA in Moscow, and he really had no choice when they cut him off. So he had to do that. So they forced his moves in this area. So
Okay, so when you say like this Asian Bretton Woods, we're looking at possibly a gold or gold partially gold backed type of a currency from the BRICS nations. Nick, should they go forward with this, or should it emerge? Would this then force the U.S. to say, "Hey, look, we really have 8,000 tons of gold. We're going to back our currency as well"?
well, you see that the dilemma is going to be that um, the U.S. purports to have 8,000 tons, and China, for example, their central bank has 1,600 tons. But what isn't counted is China's sovereign wealth fund. So China's been accumulating gold in the sovereign wealth fund, which doesn't report anything to anybody. And some of the analysts estimate that the sovereign wealth fund has north of 6,000 tons. China's stated objective is to have more than the U.S., and they can move the gold from the sovereign wealth fund to the central bank anytime they feel like it. So they'll do that once they've stopped accumulating, because right now the gold price is undervalued, so they're getting a deal as they're accumulating. But if they in the future announce that well, we just moved 5 or 6 thousand tons from the sovereign wealth fund, and we now have 8,000 tons, just like the U.S. The problem is going to be, where did they get that gold from? Because the two main reporting services are GFMS and CPM, and they do a supply demand analysis down to a fraction of an ounce. So the gold has already been accounted for. And if China announces that they have this, hidden trough of gold, where did they get it from? Well, it's leased gold coming from Western central banks. And the anomaly there is that a central bank, when it leases the gold, it still retains legal title to the gold, even if the gold is being melted into other bars. So the issue is we're double counting the gold. The Western central banks are showing it like as if they still have the physical, but the physical is long gone. And if China announces that kind of thing, it'll be obvious to everyone that the central banks don't have any, gold, or most of it's been gone through leasing. And then the Western currencies take a big hit.
Yeah, that's a great point, Nick, because I think years ago there were reports from the Swiss refineries that the 400-ounce bars were coming in, and what was going out was kilobars, and kilobars are
That's
what
right.
usually is used here in Asia.
That's right. So once that gold has been leased and is being resold by the bullion banks, then went to China, it's not coming back.
So let's say there is this type of a backing of the currency with gold. What then happens to the gold price for all the people out there who are holding gold coins and gold bars? What happens to the gold price then?
Well, the gold price, like people say, well, there's not enough gold. Well, there's not enough gold at 1,700 an ounce. There's plenty of gold at 10 or 20,000 an ounce, to back all the currencies. So it gets a massive repricing when that happens, and the repricing would happen very quickly. So the issue now is there's a huge opportunity to buy gold and silver at discounted prices, and in the future it'll get very difficult, if not impossible. We're finding it's progressively getting tighter as orders come in and so on. So uh, it's already happening, and silver is particularly grossly undervalued. It's about half of what it should be just to catch up to the gold price.
If you're enjoying this interview with Nick Barisheff and I, please consider subscribing to our YouTube channel and let the algos know you'd like to see more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, we see that with silver as well. The spot price may be low, and we see people looking for that spot price to go even lower, and they're planning on jumping in and buying silver. But what's also happening is the premium. The premiums for silver, they're not really coming down. If anything, they're holding steady or perhaps even at times going up.
I think in silver, because it's at this point largely a commodity use and largely for electronics. Companies have gotten a taste of what it's like if you don't have a chip. Like Taiwan makes most of the chips. If you don't have a chip, you don't make the end product. So you've got a situation that if you don't have silver, you don't make a lot of the electronics. So there's a very small amount of silver in, say, a cell phone. So it doesn't matter to the price of the cell phone whether silver's $18 or $180. The price of the cell phone doesn't change that much. But without the silver, you don't make the cell phone. Secondly, most of the silver is byproduct production. Is very little silver is from pure silver mining. So if the price of silver goes from 18 to say 180, you can't ramp up production. It is what it is. So it's essentially supply and demand inelastic. And at some point, this is going to dawn on the manufacturers, like it did in, I think it was 1998 with Ford Motor Company, where they were using palladium for gasoline catalytic converters, and they realized that without palladium they don't build any cars at all. So they went out and bought $5 billion worth of palladium all in one shot in physical and took delivery. Someone's going to do that with silver just to stay in business for their manufacturing company.
Yeah, I completely agree with that. I can see it happening, and if it would happen with one company, I could see it happening with another and another, knowing that these companies know that they would have to grab onto supply as well, which might not leave all that much silver for you and I, the retail investor, to pick up.
Well, exactly. Then it would become difficult to purchase if the manufacturers started doing that, and I think there'll come a time where they'll have to do it, or they will be out of business. So that's a coming trend.
Yeah, for sure. Nick, also we hear quite a lot of people, they say when it comes to gold, you should have a 10% portfolio allocation. where we are at today and looking at where we are going tomorrow, is 10% enough?
Not nearly enough. The World Gold Council has a program that allows you to allocate a portfolio with all the different asset classes and choose your percentages, and then it calculates the returns, the standard deviation, the Sharpe ratio, Sortino ratio, and so on. So a good normal basis would be like 20%. My particular view, because I'm the old school, when you look at the fact that since 2000, the average price of gold in all currencies has been in excess of 10% a year. Now, when you consider that institutions like pension funds, target returns of 6%, and many of them don't get 6. They could have just bought gold, but none of the pension, none. There's only 4 pension funds in the entire world that have any gold. We've sold one of them. So that's going to start coming in place. If you go back to the way things were when the markets got very volatile and risky, people would take their money off the table and just wait it out and buy back in. So my view, and we've set up a hedge fund to do this for people, is you sit it out in gold for the moment until the market crash happens, which is, I think, imminent. When the market crash happens, you could see declines of, plus or minus 70%. And after the decline is finished, then you reallocate and buy back in at a huge discount. So then your portfolio really performs, and then you have a balanced portfolio. But right now, wait it out in gold. So I'm going to wait it out at 100% right now.
Wow, 100%. Okay. Yeah, because we also hear a lot of people, they say, have that dry powder. So they sell off assets and they're waiting in cash. But you're saying you probably should be waiting in gold?
Yeah, there's no point waiting in cash because the cash is declining. And when you look at any of the other corrections, the gold price goes up while the market declines. The gold price particularly does well during a stagflation, which we're basically in already. So to over allocate, while this situation plays out, it is the wiser but totally contrarian strategy.
Okay. And since we're talking a bit about funds, Nick, what about guys with retirement funds, IRA accounts, 401k accounts, all of these self-directed types of accounts? Should they be considering moving some of that over into a type of a precious metals IRA account?
Well, we have like 3 mutual funds, which are open-end mutual funds. One that holds gold, silver, platinum, one gold only, and one silver only. And those are all qualified for Canadian retirement accounts. So as you go country to country. But you see, in Canada, to do an open-end mutual fund, we needed to get 6 exemptions from securities regulations. And in the United States and Europe, the lawyers have told me you'd never get the exemptions that we got in Canada. So you can't set up an open-end fund. The problem with closed-end funds, ETFs, mining stocks, and everything, when you have normally they correlate to the price of gold, but in a market decline, they correlate to the broad equity markets. And because they're so thinly traded, they end up taking, a much bigger decline than the broad equity markets. So they're useless as portfolio assets. You need something, that's priced at the gold price, not, uh, follows the equity markets down. So it's important the kind of asset that you choose, and none of the exchange traded assets will work in a decline. They'll all go down.
Okay, because we've seen where markets more or less have had a free ride up with stimulus, Fed intervention. Investors have basically stayed in the markets with a cannot lose attitude. And although today, with the potentially severe market crashes, as you said, imminent on the way, de-dollarization, inflation, hyperinflation, all of these things, how does one set themselves up for what you have called the upcoming opportunity of a lifetime?
Well, the issue is like for instance, I'm personally not in mining stocks. I don't have anything against mining stocks because I think in the coming market crash, they're going to get decimated. So when they do, they'll be the bargain of a lifetime, and that's when I'll sell some bullion and buy some mining stocks.
And you touched on hyperinflation and even stagflation. What do you recall about that time during the 70s when we had went through it?
We've had different levels of inflations and stagflations and so on, and when you look at each period, the gold price did the best during a stagflation. But there was a study done out of England quite a number of years ago where they looked at gold during a deflation, and gold did very well because uh, it lost less than everything else. That was the kind of the conclusion.
Of course, during that time, the 70s and 80s, we saw gold move from I think about $35 an ounce up to 700, 800 plus dollars an ounce. You think we're looking at the same type of price movement again coming around the corner? And I know you've said 10,000, but we're kind of looking at maybe that 10,000 is a bit conservative.
Well, I think it's highly conservative now because the conditions that we're faced, economically all over the world are many times worse than the late 70s.
Nick, with what the U.S. is doing as far as sanctions against Russia and how Russia has formed up pretty well with um, India and of course China, has the U.S. actually pushed de-dollarization to maybe happening a bit sooner than it would have liked?
Well, I don't think they can do anything about it when it comes to Russia and China when other countries like, you know, uh, Iraq tried it, and uh, Gaddafi tried it and so on. They were able to take him out, uh, but they're not going to be able to do that here. And the main strength of the U.S. dollar is the fact that oil is priced in dollars, and China is actively negotiating with the Saudis to price oil in yuan. So if that happens, then the thing that maintained the U.S. dollar reserve status goes out the window.
So even though we're seeing like a dollar strengthening against other major currencies, and even though it is the current world's reserve, global reserve currency, a lot of people seem to think that you don't have to worry about it. But when you talk about these things where the petrodollar, so to speak, these are things that can really start to diminish the use.
The dollar only appears to be strong because the other currencies are so weak. So it's not that the dollar is increasing because it's fundamentally strong. just the best of a bad bunch, you know.
A lot of people in our space, they do think that we are on our way to central bank digital currencies. Uh, are you familiar with them, and what's your thoughts on these central bank digital currencies?
Well, it's certainly a number of central banks are working on that, and I can see the motivation to do that, but I think it'll be devastating for the population if they do, because then they'll be able to control everything. If you do something they don't like, they can just cut you off from your bank account and your currency and so on. They have total control in.
Right. And this was something you saw up in Canada with the trucker situation, right? Where if you had
That's right.
supported the truckers, your bank account was frozen.
Right. And we've had quite a number of people open Bullion accounts with us after that and took out all their money from their bank account and put it all into physical bullion.
Wow. Okay, interesting times for sure. Nick, how how did we get to this place where I mean, was it the overprinting? Was it the infinite wars? Well, what happened? How did we get here?
Well, it took a long time. It's been ongoing since 1933, you know, so it's just chipped away, chipped away. They made it illegal for U.S. citizens to own gold in 33, and that lasted till 74. In 71, Nixon, removed the backing of gold in the U.S. dollar and so on. It's just step after step. It's been ongoing for the last 70 years.
Okay. Nick Barisheff, we kind of touched on a lot of interesting topics from history to maybe what may be happening in the future. For our viewers, how can they learn more about you and follow you as well?
Well, we have two websites: the BMG website for our products, the mutual funds, and our physical bullion program, and then we have another, the BMG DIY site, which is for do-it-yourself investors. So it has a lot of information that's useful for investors that are doing their own investing. Then we publish a weekly newsletter, and I've been doing that for 20 years, and I try and do articles and interviews and keep people informed as best as possible.
Yeah, Nick, with BMG, if you don't mind sharing with us, what are the things, the thoughts in your investors, in their investors' minds? I mean, what are their deepest concerns right now?
Well, the trouble is it's not any one thing, because we've got product from the mutual funds that are primarily for registered accounts, like RSPs, and then we've got the physical bullion program, which we have investors from all over the world, and that tends to be uh, much larger investors, some family offices. We've got numerous investors that have over $1 million in storage with us. So there isn't any one attitude. People have their own kind of reasons.
Okay, and so people can just head on over to your website, bmggroup.com,
Right.
was it?
That's right.
Okay. All right, Nick Barisheff, we appreciate the time you've given. I really do hope we can do this again soon. And you are absolutely in touch with a lot of what's going on, and I do hope that these investors do make their way to you. Appreciate the time.
Right. Well, great. Thank you. It was my pleasure talking to you.
That was Nick Barisheff sharing his views on the economy and gold and silver. For more info on Nick, please visit his website, bmg-group.com. If you like this video, please subscribe, share, give it a thumbs up. Audio-only versions of this interview can be found on iTunes and Spotify.